Welcome to the deep dive video. This video looks at all the different charts that I didn't necessarily cover in the daily video updates and just post them in one shorter video where we can look at things because sometimes we can still get some extra insight for this. I'm thinking of changing the name of the deep dive video. It might be a little bit misleading. I look at it as going deeper into things that are not really blatant right now to try to reach some conclusions about what's going on in the market. This is being prepared for Monday, May 15th. The first thing that we look at is the VIX range. This is a 50-period moving average of the VIX. The VIX is actually on this chart, but I've made it invisible. And then you see this blue line, which is a 50-period exponential moving average. This gives us an idea of what kind of range is the VIX trading in longer term. Back from 2008 into 2011, we had an upper range of above 40 down to about 20. Then we dropped down to a range of about 20 down to 13 or 14 or so. And now we've gone back up to the 27, 28 level down to a little bit under 20, and we continue to fall overall. This next chart is a study that I place on the VIX, taking an RSI 9 period to see when we've gone extreme positive or negative. Right now, we're just about at the midpoint. Then this is a ratio chart taking the VIX and then a 3-month average of the VIX to try to get an idea of how is the VIX heading. We can see that it is heading lower overall. I also plot a 50-period exponential moving average on here to give us an idea of the general movement overall. But this is just showing that there's not an awful lot of fear in the market. We also look at a ratio of the VIX to the VIX of the VIX to see if there's any insight from this. This black line is the actual ratio, and then we also have a moving average giving us the general idea of the range. This is also showing that fear has really been coming out of the market. Another thing that we look at is sometimes the VIX acts pretty strange, and so I take a correlation of the VIX to the S&P 500. When we get really high readings, that can generally signal some kind of a top or bottom in the market. Right now, we're not getting anything that's really out of the ordinary. This is a one-day chart of the equity put-call ratio, just showing how it goes up and down. Generally, it follows what has been happening in the market. Here's a 5-period simple moving average of the equity put-call ratio. And then the chart that you usually see is a very long-term chart, and we use that to generate signals when the market has typically hit a bottom. This is a really long look at the equity put-call ratio, a 253 simple moving average. That's the number of trading days in a year, and it shows that for the most part, we have been going up overall. I know right now the VIX is very low, but if you look back on this chart, right at the beginning of 2022, that's when we started to hit trouble and started to go up. Well, when we see this turn back down, that should mean a shift into a more positive atmosphere for the stock market. We also look at the retracement going back to the all-time high, which is now off of the chart. We're down 14.41%. And then over on the right-hand side, you can see where we closed on Friday. This just measures all the times that we've been above and below 4,000. It seems like we can't get very far away from that level. Then we look at technical alerts. I get these every day. These are just for Friday's session, May 12th, and they're automatically generated by stockcharts.com, and you can go and look at those. They look at not only the S&P, but different sectors and different indexes to tell us when something has happened. We typically read this from the bottom up, where at the very bottom, we see after the open, the S&P had a BPI crossover above 50, and then things turned negative after that. The energy sector had a bearish crossover. That would be a death cross. The NASDAQ went below 12,300. The S&P went below 4,100. It did bounce up off of that. And the summation index crossed below zero for the NYSE. Then we look at different indexes that we follow. The main ones are the Dow, the S&P, mid caps, small caps, and the Qs represented by the NASDAQ 100. And then we rate them on what's called a scooter score. It's a 0 to 100 score. The higher to 100, the better the technical chart is looking. Coming in first place right now is the Qs at 97.3. In second place is the S&P 500 at 73.9. In third place is the Dow at 37.6. In fourth place are the mid caps at 22.6, And then in last place are the small caps. And we've been seeing a lot of weakness in this area, and it comes in this week with a score of 9. Looking at some short-term charts, this is a rainbow going from 10 periods up to 50 periods, and we're dancing around a little bit inside of the rainbow right now. I don't show this in the daily videos because this can get really messy, and I'm not sure if it really gives much insight. We also look at a thing called the CMB Composite Index. This is a short-term trading model. The idea is that when we cross below one of these lines, it's confirmed when we cross below or above the other line. I use this in a little different way. I tend to use this more like an oscillator when we get extreme positive or negative readings, and right now we're just about in the middle. We also look at a 20-period triple and double exponential moving average. Lately, I've been showing the 50-period moving average in the videos. This is the short-term trend measurement, and we're just a little bit below that level right now. We also look at the Stochk RSI, which is strange. This usually pops up in just about every daily video, but because we've been chopping sideways, this is a short-term sensitive indicator to give us overbought or oversold conditions. You can also look at it as a form of momentum. When we're going up, that's positive. When we're going down, that's negative. Similar to that is the Williams percent R. It's also not giving us any kind of an extreme reading and hasn't for a few days. The CCI 14, also pretty touchy. It's just about at the midpoint. We tend to look at this most when it gives us an extreme positive or negative reading, and the same thing is true with the 20-period CCI. This is a blog post that I was reading over the last few days showing some different studies all in one chart. Up on top, you have the SPY, and that's the S&P 500. And then you have a thing called the Silver Cross. And this is when a 20-period exponential moving average goes above a 50-period exponential moving average. So in the shorter term, we are now negative. Then you have a golden cross. That's when a 50-period moving average goes above a 200-period moving average, and we're pretty much sideways right now. This also measures the S&P 500 stocks above their 20-period exponential moving average, and that is declining, as well as those above their 50-period exponential moving average. And then at the very bottom, those that are above their 200-period moving average. And this is showing us that there's internal weakness in the market. And we're seeing this also in other charts where it's just a few big companies that are really taking charge of the market. If they have an up day, we go up. If they have a down day, we go down. In the intermediate term, we have the Connors RSI, which works just like a regular RSI. We tend to look at this when it gives us an extreme positive or negative reading. When it's above the dashed line, that's positive. Below the dashed line is negative. We're currently more negative and not getting an extreme reading. Here's an intermediate term rainbow looking from 50 periods up to 100 periods, and we're currently above all of the plotted moving averages. Ease of movement, I usually don't use the 1 period all that much. I look more at the 14, and we're just at the midpoint currently. Then I take a 20-period simple moving average of the open, high, low, and close. Oftentimes these will provide support or resistance, but as we've been chopping around sideways, they really haven't been that helpful. We also have a moving average study. The 20-period, 50-period, and 200-period exponential moving averages. These are declining overall, but we're just about at the midpoint right now. The Bollinger Bands were also at the midpoint. We're not getting any kind of an extreme reading. And this is also a standard deviation study. We're just a little bit above the midpoint and not really giving us any insight. Percent B indicator, which is a derivative of the Bollinger Bands, we notice this mostly when we get extreme positive or negative. That means that we've gone up or down too far, too fast. Right now we're at the midpoint. We have the boom indicator, how far stocks get away from their moving average. This is a 20 period on the top, and we're about at the midpoint. Then we have a 50 period and 200 period, and it's not giving us any real extreme readings. The NASDAQ with fib levels on here, we haven't reached this upper 38.2% retracement level yet. We're about 150 to 200 points away from that happening, so I'm watching this. This is the distance away from the 200-day simple moving average. As long as we're above this, our long-term trend is considered positive. The Sean trend meter, we're not really trending, so it's been chopping around more or less sideways. And we're well above the 50-period moving average, as well as the 100 period moving average. The RSI based on 14 periods and 9 periods were just about at the midpoint. We're slightly above 50 on both, so that's a little bit positive, but we are turning down. Point and figure chart is not telling us anything new, so I don't bring that up. The Copic curve is not generating a signal. If we cross above this red line, that would be a signal, and that would be a positive signal. The Pring bottom fisher is not generating a signal, and the mass index is also not generating a signal. Some longer term charts. Here's a longer term moving average study. I mainly look at the 150 and 200. The 50 period simple moving average is really just for reference. We're falling down below the midpoint, so that is slightly negative and not giving us an extreme reading. Then a long-term rainbow going from 50 periods up to 250 periods, we're still above all of the plotted moving averages. Then I usually include this in the possible positive scenarios, but this is a measurement of what stocks in the S&P 500 are above their 200-day simple moving average. That's continuing to decline, and it's just about at the midpoint. When we really pay attention to this is when it goes extreme negative or extreme positive. Then this is a podcast I was listening to where they take a very long look at the S&P 500. They have a long-term cycle. This blue line is an 80-month simple moving average, and this chart is also a monthly chart of the S&P. And then they also look at a 23-month simple moving average. When the red line crosses above the blue line, that's more positive economically. We can also use this as a potential long-term support or resistance. We're coming right back up to the 23-period simple moving average, but we still maintain a positive stance longer term. Looking at some broad market measures, this is the VIX of the NASDAQ 100, and they call it the Vixen. I don't use this chart because of all this crazy data up here. If you look at the bottom, it's showing that fear is really going out of the NASDAQ 100. Some rate of change charts going back 250 periods, we are showing some improvement and we're able to come above zero. This is even longer term, also showing some improvement. Looking at bonds, this is a 2-year yield chart, and then we compare that to the euro dollar. Now, euro dollars are not dollars in Europe. Euro dollars are US dollars that are outside of the US. And this is a pretty good proxy for the Fed funds rate. We only get that updated when there's a change or at the end of every month with the Fed funds, where the euro dollar is pretty close to that same reading. So we can use that to look at what are interest rates doing in the short term, and we compare that to the 2-year yield. And they have a real strong tendency to go in the same overall direction. So this doesn't really tell us anything we don't know. It's just kind of a good idea to keep an eye on this. Then we look at cash, which is represented by the 1 to 3 month bill, ETF. And then we look at longer out interest rates, the 3 to 7 year bond ETF. When this is going down, that means things are shifting back more positive. And we've also seen a recent death cross in this ratio. When we were going up, that means there's a lot of uncertainty and they don't know what's going to happen about interest rates. The market is starting to feel a bit more comfortable about that based on this chart. And as long as this keeps going down, that could be positive for the stock market. Then we also look at a weekly chart of taking the 1 month yield and then subtracting the 3 month yield. It had gone down really, really far. That was an extreme negative reading. Well, now we've popped back up to getting a real extreme positive reading. So there's a lot of volatility that's happening in the short-term yield markets. So thank you. I hope you found this helpful. Please feel free to check out the daily video, the weekly video, the intermarket analysis video. I also posted a supplemental video about a week ago that you might find helpful. I hope you have a really great day, and I will talk to you in the next video.